$315 trillion. That's the estimated total global debt. Every country owes. Every major economy is leveraged. So here's the uncomfortable question. If everyone is in debt, who's actually the creditor? Because someone has to be holding the other end of that promise.
That's the right place to start. And the answer surprises people. The creditor isn't one country. It isn't one institution. It's the system itself. Governments issue bonds. Banks, pension funds, insurance pools, and central banks buy them. Then those same institutions are backed by the savings, taxes, and retirement contributions of citizens. So in many cases, we're both the debtor and the creditor. The power doesn't sit in one place. It sits in whoever controls confidence in that loop.
So when we say the US owes trillions, most of that is internal. Walk us through it in simple terms. How does taxpayer money somehow circle back into retirement accounts?
Sure, the Treasury issues bonds. Pension funds and mutual funds buy those bonds because they need stable assets. Americans contribute to those funds through 401ks and savings plans. The government pays interest on the bonds using tax revenue. That interest flows back into the funds, which boosts retirement balances. It's circular. The debt is real, but much of the interest is being paid back into the domestic financial system. That circularity is what keeps yields relatively contained.
So wait, if it's that circular, then why does it feel so fragile? Because when central banks step in and create money to buy bonds, people panic. What's actually happening behind the curtain there?
Well, when a central bank buys government bonds, it credits the banking system with new reserves. It doesn't print physical cash in trucks. It expands its balance sheet digitally. The bond moves onto the central bank's asset side, and new reserves appear on the liability side. That matters because it lowers yields and increases liquidity. For everyday investors, that usually means asset prices get support: stocks, real estate, risk assets. But it also quietly increases long-term inflation risk.
And that brings us to the part people don't like hearing. Sovereign debt isn't designed to be paid off. It's rolled over. So what actually keeps that cycle stable year after year?
3 things: growth, inflation, and trust. Growth expands the tax base. Moderate inflation reduces the real burden of old debt. And trust keeps buyers coming back to auctions. As long as investors believe the government can service interest, not eliminate principal, just service it, the machine keeps running. The bond market is the bigger signal here, not the debt headline number. Yields tell you whether trust is intact.
Okay, let's challenge that. If confidence is the glue, what's the first real crack we should be watching for? Not noise, but a structural warning.
Persistent rising yields despite central bank intervention. That's the signal. If borrowing costs climb and stay elevated, even when policymakers try to stabilize them, that suggests the market is demanding a higher risk premium. Currency weakness alongside that would amplify the stress. That combination, rising yields and falling currency, is historically where crises begin.
Retail investors hear $315 trillion and assume collapse is inevitable. What part of that number is misleading without context?
It blends household debt, corporate debt, and sovereign debt globally. Not all debt is equal. A mortgage tied to a productive asset isn't the same as short-term foreign currency borrowing. Also, much of global debt is denominated in domestic currencies. Countries that borrow in their own currency have more flexibility. The risk isn't the absolute number. It's mismatches, currency mismatches, maturity mismatches, and slowing growth.
Interest flows upward to asset holders. So, for smaller investors watching this, how do they position themselves on the right side of that transfer instead of just funding it?
They need exposure to productive assets and income-generating securities, bonds, dividend equities, real assets, instruments that participate in that interest flow. Sitting entirely in cash means you're only on the paying side of the system through inflation. Participation matters. You don't need to be large, you need to be allocated.
We've seen countries hit breaking points: Greece, Argentina. Before the headlines exploded, what signals were flashing that people ignored?
Debt to GDP ratios rising without growth. External debt in foreign currencies. Widening budget deficits during stable economic periods. And critically, political paralysis. Markets tolerate high debt if there's credible governance. When credibility erodes, the repricing is fast. That's the pattern across cycles.
Let me push you here. If governments realistically can't pay this down, at what point does refinancing stop being strategy and start becoming structural risk?
It becomes structural risk when interest costs consume a rising share of tax revenue without growth offsetting it. If more borrowing is required just to pay interest, not fund services, not invest, that's when sustainability questions surface. We're not there in most major economies yet, but the trajectory is something institutions are watching closely.
5 to 10 years out, does this system inflate away quietly, evolve gradually, or face a sharper reset?
Gradual adjustment is the base case. Mildly higher inflation, periodic volatility, selective stress in weaker economies. A sharp reset requires synchronized loss of confidence across major sovereign markets. That's rare. But, and this is important, the bond market will telegraph it early. And we're already seeing more sensitivity to fiscal policy than we did a decade ago.
So the real story isn't who's the creditor. It's who controls confidence in the credit system, and whether that confidence is starting to thin.
Exactly. Debt is sustainable as long as trust is. The next phase won't be about the size of the number. It will be about the price of money, yields, currency stability, and who absorbs the cost of adjustment. That's where investors should keep their eyes.
And that's the tension. If the system depends on rolling promises, the only real question left is how expensive those promises become. We'll be watching the bond market, because that's where the next signal shows up.